Hello everyone, today's my topic is dynamic interrelation between stock market index, exchange rate tables and policy rate, the case of Egypt from 2010 to 2020. Overall, our introduction for today is that dynamic securities market is the engine of the country's economy and that the stability and the strength of country's financial intermediates and the secondary market system is always playing a role in the economic growth. Since 2009 and development in these stock markets and the treasury secondary market, the Egyptian economy has been on a higher economic growth and upward trend in its growth. However, Egypt's economy has been facing different challenges, starting from 2011 political revolution and then the pandemic, which had a negative impact on the foreign capital inflows from the hard currency. It is assumed that Egypt's economy is moving towards a more co-integrating economy, especially after the IMF loan agreement that took place end of 2016, associated with a currency flotation in the 3rd of November 2016. Since that, Egypt's stock market, foreign exchange market played a more reflective factor, and it made Egypt more having weaknesses towards the external shocks. And with the association with the IMF loan program, the financial capital market, via its foreign capital inflows in Egypt's external sector from the foreign portfolio investment, it played a main role in impacting the currency performance through Egypt's equity and debt markets in a direct and indirect way, influenced by Egypt's central bank monetary policy decision. Thus, these papers aim at clarifying the factors that decide the financial markets, the factors, and also investigate the relationship between macroeconomic variables in Egypt, impact of it on Egypt's stock market index. The research importance is that the critical to have a highlight on the macroeconomic variables interrelation, especially in emerging economies like Egypt, and to help in understanding the interrelation between macro variables for policymakers and investors to assess the economic stance in Egypt. The research gap is despite the concept dynamics and the complexity of the interrelation of Egypt's macroeconomic variables, there is still limited number of research papers focused on clarifying the interrelation between Egypt's stock market, interest rate, exchange rate, and other economic variables. Research objective is to analyze the dynamic interplay between Egypt's key macro financial indicators and their impact on the stock market performance. The data used is to capture the trend that took place since 2011 revolution, the 2016 currency flotation, and the corona pandemic that took place in 2019 globally and domestically in the beginning of 2020. The 4 questions that guided the study is there a relationship between stock market return and treasury bill rate? Is there a relationship between stock market return and interest rate? And if there a relationship between interest rate and treasury bill rate? And the last one, how does interest rate and treasury bill rate can jointly impact the stock market returns? The data collected were analyzed through eViews software version 11. The hypothesis and the data. The 4 questions is 4 hypotheses is H1 is there a negative relationship between stock market returns and treasury bill rate? Hypothesis number 2 is there a negative relationship between stock market returns and interest rate? And H3 if there is a positive relationship between treasury bill yield rate and interest rate? And the H4 if there is a positive relationship between stock market return and exchange rate? H5 if there is a joint impact of a negative relation between treasury bill, interest rate, and stock market. All the variables here in the table summarized. The data are taken from the Central Bank of Egypt. Egypt's stock market return is the dependent variable. Egypt's lending rate is the independent variable. Egypt's treasury bill yield is the 3 months yield. It's the independent, and the exchange rate is an independent variable towards our analysis, which involve regression, co-integration, and Wickham model. So the results and the findings, descriptive statistics showed that the variables are not normally distributed and could be further having a speculation and periodic changes. The correlation test showed a strong, significant, positive linear correlation between lending rate and treasury bill, weak insignificant between stock market index and tables and stock market index and lending rate, a weak insignificant relation between Egypt's stock market index and exchange rate. A lag order selection criteria was used. The optimal lag was 8 to test the long-run relationship between the noted variables by applying the co-integration test, and also I used the augmented Dickey-Fuller unit root test to analyze that the variables are not stationary, so to proceed with the co-integration. So the results and the findings show that there is a negative relationship between stock market returns and treasury bill rate as hypothesis number 1. It showed a positive weak relation, not significant, at 5%. The R-square was too low, indicating that variation in the stock market performance cannot be explained by the treasury bill rates movements. H1 is rejected as it's not statistically significant. Supports the argument that the financial markets or the securities market in the Egyptian market is not correlated and inefficient, and it failed to capture the funds reallocation between treasury bill market and stock market when there is a change in the monetary policy dynamics. And then for testing and applying a regression for H2, if there is a negative relationship between stock market returns and interest rate, also it showed a positive weak relationship between interest rate and the stock market returns, as it was not significant at 5% with low R-square. The stock market performance couldn't explain the treasury bill movement, and there might be other values that contribute to the explanation, which again indicates that the financial market in Egypt is not efficient and doesn't show the reallocation of the funds with a policy rate hike or a rate cut. So H2 also is rejected. And then in testing H3, if there is a positive relationship between treasury bill yield rate and interest rate, it indicated a positive relationship between interest rate and treasury bill rate that is strong and positively correlated at 92%. But the co-movement between the lending rate and the treasury bill rate are moving together could be an indicator that reflects the movement of the monetary policy rate. However, due to high correlation, it's creating a multicollinearity, which gives an unbiased judgment about the relationship between the noted variables. Meanwhile, R2 was high at 85%. H3 is accepted, however, due to high correlation, it gives a biased illustration to the relation between the two variables and limit its testing both variables, which is the T-bills and the interest rate, in a combined model further. And then in testing H4, if there is a positive relationship between stock market returns and exchange rate, it showed that the relationship between the variables were significant at 5%, and it reflected a positive relationship with the stock market index. However, the coefficient of determination was too low at 17%. The time series of the sample data from 2010 to 2020 were divided into two durations. The first one is the 2010 to 2016, and the second one is 2017 to 2020. To avoid the structure breakouts at the time of the 2016 currency flotation, which we will show in the next chart. The results showed that there is insignificant relationship between the two variables at 5%. Between the variables in the duration we mentioned, Jan 2010 to October 2016, and Feb 2017 to December 2020. H4 is rejected, and another single of market efficiency was observed. So here in this hypothesis, when we applied the regression on the whole data we had a significant relationship, but when we removed the structure breakout, it turned to be insignificant. Thus, H4 is rejected. So here, this chart will explain to us more that this is the structure breakout or the IMF loan agreement with its currency flotation regime implemented by the government. So here it showed a significant relation between our variables, but it's not really significant. So although the relationship between the interest rates and EGX 30 and T-bills and EGX 30 is not significant when the regression was applied on the whole time series of the data between 2010 to 2020, it happened to be significant at 5% at the time of Egypt currency flotation here between these duration with a low R-square for both variables, thus excluding the outlier of this duration. We will do that in our further analysis through the co-integration and the vacuum model, that we will exclude the outlier. So in H5, for testing the joint negative relationship between treasury bill yield rate and the lending rates and stock market index, here we removed the outlier and divided our results into two durations. The first duration, as we said, 2010 to 2016. Second duration, 2017 to 2020. It was divided into short run and long run. after applying the Wickham model. This is a summary for the Wickham model. So in testing H5, the co-integration testing was applied to test the presence of a long-run relationship via the trace test and the maximum eigenvalue. The trace test showed two co-integration equations at 5% between the EGX30 and the lending rates, and also between the EGX30 and the T-bills. However, a co-integration test with 3 variables and over the whole time series, as we said earlier, without a data split could not be applied due to the multicollinearity, and to be able to capture the structure breakouts and to have one credible model. The coefficients of the long-run co-integration equation for each variable, lending rates and T-bills yield rate were significant at 5%, reflecting a long-run relationship between the noted variables. It indicates a co-movement between stock market returns and treasury bill rate and interest rate in the long-run equilibrium, which is reflecting also a linear stable long-run relationship among the variables. Following that, after we had the results of the co-integration, we applied the Wickham model, was implemented to assess the short-run causal relationships, and the results which we explained here show that the H5 is only accepted in the duration of 2010-2016, this part, and that there is a stable negative relationship between the variables. So the whole duration of the short run, it was insignificant, but on the long run, only that duration, the first duration before currency flotation, was significant at 5% for lending rate and at 10% for T-bills yield rate. Thus, the conclusion and main discussion points, the results showed that the 2016 IMF loan agreement and the economic reforms that took place starting currency flotation 2016 had an influence on changing the economic political stance in the country. It gave an insightful observation that the government interference over the whole sample data from 2010 to 2020 made the time series data to seem to be correlating, and that the foreign exchange market and the securities market are having a significant relationship. However, when excluding the outlier of the economic political intervention in the market, with the 2016 currency flotation, it came to be uncorrelated. The above findings are contradicting with a previous study by Kamal 2018, who empirically proven that there is a significant joint negative impact on the short run and long run, and on the long run of T-bills, 3 months deposit rate and lending rates on Egypt stock market returns over the duration from November 2004 to November 2017. Also, the results are not aligned with both Alam and Salah Abdin 2009 and Spiro 1990, who indicated the presence of a negative link between real interest rates and stock market in Egypt, which is supported by the default economic argument and observation in my presented paper that the duration 2016 to 2017, that when an interest rate increased sharply, investors would rather put and invest into risk-free investment, given that Egyptian investors would view investing in stock markets are more risky, and low rate of return on this investment doesn't make them want to give up on the low-risk kinds of investment. Thus, Egypt's market is inefficient and not regulated freely, even though it's under a flexible exchange rate regime. Thank you for listening, and thank you for your time.